With a fixed universal life product, you get a crediting rate declared by the insurance company, and they're supporting that with their general account assets. With a variable universal life policy, you invest directly into funds, mutual funds, insurance dedicated mutual funds that are held in a separate account. And so that's the investment return is whatever it is. With index UL, the carrier basically says, all right, instead of paying the crediting rate to the policyholder like we do in a fixed universal life policy, we're actually going to take that crediting rate. We're going to go out and we're going to buy call options. And all a call option is exposure to the performance of an external index. And so by buying these call options, we now can give these index linked credits to the policyholder instead of the crediting rate in the universal life policy. So one of the key things to know right off the bat is that universal life and IUL are essentially the same product. The only difference is that with universal life, the carrier gives you the crediting rate. In index universal life, the carrier takes the crediting rate, goes to an investment bank, buys call options, and then that gives the client index linked exposure. So the fundamental math, the fundamental mechanics, all the underlying financials are identical, except for that last step where the carrier takes the crediting rate, gives it to the investment bank, buys options, and the options provide the index linked exposure. Now, that's also the part where it gets really complicated, because I think when you look at all the stories about IUL, like what this thing does, how it works, mentioned it, downside protection, upside potential, equity-like returns, better than a 401k. Nobody would say all that about just a regular old universal life policy. But the only difference between universal life and indexed UL is that options piece, that very last step. And what that does is create this kind of illusion and this veneer that IUL is something fundamentally different, that it's an equity product, that it does all these magical things. And the reality is all it is really just a universal life policy where the carrier, again, takes the crediting rate, instead of giving it to the policyholder, gives it to an investment bank to provide index linked exposure. And that's it.